Hi, welcome to my weekly market wrap. In this video, you will basically try and put together what that video which I had recorded on Wednesday last about the ATP versus the LTQ on the screen reading tutorial that I just sent you, how you can implement those strategies based on the 5 high beta and low beta stocks that I give you towards the end of each weekly market wrap videos. Now you see pieces of the jigsaw puzzle will start falling together and a larger game plan that I want to share with you for free. Yeah, free. Based on my 34 years of trading experience. How that game plan is falling into pieces together on a jigsaw puzzle board, and how by the end this series of how to become a millionaire trader ends. I assure you, you will be a far better trader than you were before you watched the entire series. So coming back to the weekly market wrap, let me just recap what happened. The markets basically continued to rally and the indices continued their gravity-defying movements. Of course, on Thursday there was a little bit of profit taking, but it was mild compared to the kind of rallies that you saw on the remaining 4 trading sessions. So largely the markets ran upwards for 4 out of 5 trading sessions, which is not bad at all. Now coming up on your screen is the market roundup, and as you can see, the Nifty went up 1.93% on a week-on-week basis. The Bank Nifty rose 1.84%. I had advocated that the Nifty, being a broader-based index composed of 50 stocks and therefore relatively more stable, would outperform the Bank Nifty, which is made up of 12 stocks, of which 10 are reasonably weighted and 2 have weightages so small that they are insignificant to move the index much. Now the reason why gold and silver went down, as you can see on your screen, it's the gold went up 0.31% only, and silver went down 0.12%, because risk appetite for riskier assets, which is stocks mainly, went up. This is called risk on sentiments. When traders are willing to take on a higher extent of risk and therefore they ease back on buying momentum on safer asset classes like bullion and bonds. Speaking of bonds, the 10-year benchmark bond yield, as you can see on your screen, went up to 5.94% from 5.90% in the week prior to that. Now the fact that the bond yields have gone up, which means bond prices have come down. And bond prices have come down because, as I mentioned a couple of seconds ago, risk on sentiments. Movements are basically seeing inflows of money in equities and outflow from bullion and bonds. The market-wide position limits, the MWPL, which was 20.93% in the week before last, went up to 24.46 last week. Coming up on your screen is the MWPL chart, which shows a steady advance of open interest as traders continue to ramp up exposure on expectations that the momentum of the build-up in the rally in the indices will continue. However, as the chart very clearly indicates, the velocity, the momentum, the speed at which the rally in open interest is occurring has definitely slowed down as compared to the last couple of months. So which means the traders are participating somewhat lower on higher levels. Now there are 2 reasons why this could have happened. One is the peak margin issue, which is in place since 2 weeks now. And secondly, the upcoming holiday season, where traditionally the FIIs tend to have a lower exposure in the markets because of Christmas and financial year ending towards 31st December. So traders are basically exercising caution and therefore open interest is lower. And let me warn you, under such circumstances, volatility tends to go up because a little bit of buying or selling and prices move in an exaggerated manner. So this is why I've been on my social media accounts wherein I put up post-market statistics every day. I've been warning and cautioning my followers on social media to trade with a smaller exposure levels. The basis chart, as you can see, is very interesting because both the indices have seen basis contraction to the extent that the basis is almost hitting zero. Now, the sharp fall in basis, I can only think of a logical reason is selling at higher levels because it's basically skepticism. Traders don't want to believe that this rally will continue the momentum that it is showing so far. And is it a sign of worry? Definitely yes, one should feel that this is a sign of caution. But should you pull the plug and say the rally is over and I'm going to go short? I think not. It would be premature to feel that you should pull the plug. But do take note of what is happening. Sit up in your chair and stay sharp. Now, coming up on your screen is the volume. Volumes of both the index and the stock futures, and the speciality about this volume chart is it is across all expiries, all future series. So December, Jan and Feb. Volumes are basically lackluster, and in spite of the fact that markets are rising, there has been no significant rally in volumes, which means the retail level participation is somewhat skeptical, is somewhat cautious. Like I said, of course, what could be one of the reasons was the peak margin rule that has been implemented by SEBI. Now the roundup done, I move to the 10-year benchmark bond yields. And as I've mentioned earlier in my previous videos, the bond market is the fountain of money source for the financial markets. So the bond yields for the discerning trader, especially if you're a Nifty or a bank Nifty trader, it's very, very critical for you to watch the 10-year benchmark bond yields because the biggest buyers and holders of bonds are banks, and any change in the prices of bond impacts their mark-to-market of their portfolio holdings on the treasury and the government paper that they hold. So as you can see on your screen, there has been a risk-on sentiment, which is why bond prices have fallen, and the yield is now at 5.94 compared to 5.90. Safe haven buying both in bullion and bonds has eased, and the fact that the RBI is not raising coupon rates, the interest rates, is also a factor in rising yields, why traders are basically selling the bonds because no fresh bonds of higher interest bearing coupon rate are on offer. And like I mentioned, these yields, the bond yields, are extremely critical for bank Nifty and banking stock futures traders. You must basically watch this because there is a definitive and established correlation between bond yields and these stocks. We will be keeping an eagle eye on the 10-year benchmark yield in the coming videos. For now, let's proceed to the Dixie or the US dollar index. This US dollar index, which is a benchmark against the global basket of currencies, went up 0.30%. after gaining on 4 out of 5 trading sessions. A strong Dixie, relatively strong Dixie, because it shows signs of bottoming out for now or seeking a bottom at the 90.50, 90.5 levels, was also another reason why the momentum in the Indian stock markets, along with other emerging stock markets, tends to have slowed down because the dollar is not falling as fast as it was falling a couple of weeks ago. So a stable dollar is basically partly explaining the fall or the slowdown in the upward momentum of bullion and emerging market equity markets. And as you can see on your screen, the 90.5 level is acting like a rough and ready support of some kind, which you and I need to watch in the coming few weeks. The last week I advocated a potential range between 92 on the upside and 89.40 on the downside, which held. The coming week is likely to see an estimated, I emphasize and underscore the word estimated, range between 92.25 on the upside and 89.70 on the downside. And if you're a trader who plays in bullion and hard asset markets like energy, you must keep a watch on the US dollar index. Friends, let's now go to the bank Nifty, which is a very liquid and very well traded index future out there. And last week I expected the bank Nifty to underperform the Nifty 50, which basically the market proved this hypothesis to be somewhat correct. And I expect that underperformance by the bank Nifty to continue in the coming week, by the way. This index, as you can see on your chart, has rallied 1.84% on a week-on-week basis. And the basis chart, which I mentioned earlier, which I showed you earlier, and there it is coming up on your screen again, shows that the difference between the future and the spot is negligible. It's almost zero. And this contraction in the basis is one small red flag that you need to keep an eye on. Volumes remain subdued and are likely to head even lower as we approach Christmas, when the FIIs, which are the largest in a single bunch of traders out there in the markets, when they go on leave ahead of Christmas and New Year. So traded volumes are likely to come down even lower. And I repeat my view that I had expressed in the previous week also, that impact costs on the bank Nifty might just go higher. Now, impact cost is nothing but the difference that you pay in the price from one lot to the next. If you are a buyer for a very large number of lots and you can't get an order fill at one particular traded price itself, you basically try and buy whatever is available. The difference between the first lot that you purchased and all the lots following them is called the impact cost. The smaller is the impact cost, the more liquid and the better it is to trade that particular instrument. So the bank Nifty impact cost might just go up, which means you're going to lose a little bit of money in slippages or the price differential between the bid and offer spreads and the incremental cost of the impact cost. So systems traders need to keep that aspect in mind and tweak their trading accordingly. Now, you might also have a little bit of a challenge in getting your orders filled, although not too much. But by orders filled means the orders getting executed. You might see a slight delay if you are a trader who puts in limit orders to buy or sell. You might just see a little more of a delay in your orders getting executed. In the week before last, the Bank Nifty index was number 5 on the most volatile list, but it rose to number 4 last week. And that basically tells you that the challenge to a trader has just gone up. Volatility, if you can handle it well, can give you higher amounts of money, but we presume that all traders are not savvy, are not expert traders, and therefore volatility might just cause a lot of mistakes on the part of the trader, and those mistakes are a rap on your knuckles, which we call trading losses. So volatility in the Bank Nifty is likely to stay elevated in the coming week also. Last week I advocated a range between 31,625 on the upside and 28,475 on the downside, which held fairly perfectly. And the coming week I expect estimated, I'm using the word estimated here, an estimated range between 32,125 on the upside and 29,100 on the downside. The daily chart shows only one day of mild declines. That was Thursday, the 10th of December. But even otherwise, the upward range has contracted on a week-on-week basis. If you take a 6-week view, as it is showing on your weekly chart now. This index has risen for the sixth consecutive week, and it remains above its 25-period exponential moving average on both daily and the weekly chart, which tells you that the upward momentum still remains intact. I, of course, continue to advocate caution that you should trade light on the index. Number one, you have uncertainty stemming from the impending holiday season, and secondly, there is a scientific reason which I just explained to you. Impact costs might go up, traded volumes might just fall, so the slippages in price will give you lesser take-home profit. So trade light, of course, and for a day-to-day updates on the Nifty and the Bank Nifty and the statistical inputs, please join me on my social media pages. The contact coordinates are coming up at the end of this video. We'll have conversations going, and I'm sure you'll take away a lot from what I put up every day on an end-of-the-day basis post-market. We'll now come to the Nifty, my friends, and the most liquid and, of course, the lowest impact cost traded instrument on the NSE derivatives segment. And I don't expect the Nifty to suffer too much by way of impact cost rise or too much by way of declines in volumes. So systems traders can continue to trade their existing setups, but of course, since the volatility is going up and liquidity is coming down slightly, you just need to curtail your exposure a little bit and cut down on big trades. Basically trade light so that you continue to earn profits from the markets. So last week this index rose 1.93%, and in the week before last, this index was number 9 on the most volatile list, but it has risen to number 7. Now that obviously means that volatility on this counter has risen. Keep a hawk eye on this, because prices can turn on a dime without a warning. That's always a challenge for a trader, especially if you're not really very savvy and nimble-footed, if you do not get in and get out and reverse your trades fast enough. Now, challenges, of course, for the traders apart, the range overall in the markets has contracted. On a relative comparative basis, the range of the Nifty has not contracted as sharply as the Bank Nifty. To that extent, it's relatively better off. You should be trading the Nifty more than the Bank Nifty in the coming week. And what I have seen is that the volatility going up and the range contracting definitely means that intraday traders, people who square up their positions on the same day, are making, relatively speaking, more money at controlled risks rather than traders who are rolling over their position from one trading session to the next, taking on the uncertainty of which way the market will open on the next trading session. Will it be in their favor or will it gap against them? And the amount of money that you're paying out in this peak margin regime scenario and rising span margins, you're basically at a disadvantage. So I would suggest in the coming week, you attempt to square up your trades intraday rather than roll them over as an overnighter. On your screen now comes up a daily chart, and it basically shows a very small tiny correction on Thursday, which was the 10th of December, just like the Nifty did. And compared to the Bank Nifty, this correction was relatively small. And this chart continues to look stronger than the Bank Nifty in relative comparison, and I think the Nifty might outperform the Bank Nifty, both on the upside and on the downside. What do I mean by outperform on the downside? What I mean is that if the markets are falling in percentage terms, the Nifty might fall fewer percentage points as compared to the Bank Nifty. Now, relative comparison apart, the weekly chart also shows range contraction on the Nifty, but it is less pronounced as compared to the Bank Nifty. The impact cost is not likely to contract too much on the Nifty 50 as compared to the Bank Nifty. And what is healthy about this chart is that the Nifty continues to trade above its 25-day and week exponential moving average, which means the market still remains with the bulls. Now, last week I advocated an estimated range between 13,675 on the upside and 12,850 on the downside, which held fairly well. And this is the 10th consecutive week my levels that I advocated in this video have held. I do expect the coming week also these levels will hold, and I project an estimated, I emphasize on the word estimated here, a range between 13,925 in case of upsides and 13,100 in case of declines. Note how both the upper and the lower targets are now above 13,000. Now, as long as the range is holding fairly accurately as the trader's expectations, it gives a huge advantage to the trader because you can then place your bets with conviction and step up the size also. So systems traders can continue to trade with this index, with the setups. But here again, just keep your traded volumes and exposure a tad low. I now come to the 5 most volatile high beta, high impetus stocks and 5 lowest beta, low impetus stocks. Remember the ATP versus the LTP system setup. It will work best with low beta, low impetus stocks. And if you are basically a kind of a trader who wants to take swing trades, buy and hold and wait for a couple of days, then of course you need to go for the high beta, high impetus stocks. Now let's get down to this list here. The high beta, high impetus stocks wherein you will take a small exposure and wait for large price moves. That list is led with Reliance Industries at number 1 with 11+% weightage in the Nifty 50. This stock can actually have the potential to move the markets in its own direction. Number 2 is PVR Cinemas. Number 3 is Hindustan Unilever, the FMCG heavyweight out here. Number 4 is ITC, which is now blazing its own track by rising phenomenally on an intraday basis and also on a day-on-day basis. So ITC is something that high beta, high impetus traders will watch out for at number 4. Number 5 is Dabur, our very own Indian FMCG/pharma company. Now the low beta, low impetus stocks which will favor the LTP versus the ATQ trader. Led by Federal Bank at number 1, number 2 being Bata, number 3 Larsen & Toubro Housing Finance, number 4 Tata Motors, and number 5 Bajaj Auto bringing up the rear. Now coming up on your screen are my contact coordinates. I would love it if you connect with me on my social media pages. We can get conversations going, exchange ideas, and you can watch the post-market statistical data that I put up there every day, Monday to Friday. In the comments section, I would appreciate it if you tell me what you think of this video. Don't forget to click like if you agree with what you saw, and help me reach out to fellow like-minded traders who are looking out for a well-rounded 360-degree worldview of financial markets based on sound logic, by referring my video to your family and friends. I wish you a very, very profitable week ahead. Thank you for watching my video and do take care. Bye-bye.